Hi, everyone. This is Jason Bierak of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is hedge fund manager Dave Kranzler. Dave traded bonds on Wall Street. He runs a popular blog, The Golden Truth, and his hedge fund is Golden Returns Capital. So thank you for coming back here today, Dave.
Oh, my pleasure. Thanks for inviting me.
All right, Dave. Well, my first question is related to the big drop in the gold and silver market. And in the past, I would say 6 to 8 months, there's a lot of industry experts in precious metals that have been saying that, gold and silver bottom, it's going to take off soon, et cetera, et cetera. And, even after QE3 and QE4 was rolled out last year, everybody said, this is a moment where gold and silver were going to take off. But yet, it didn't take off, and instead we had a big drop last week. And there's a lot of people out there that's been saying, from investor to industry expert, that the takedown was engineered. Do you agree with that? And why did they decide to do it now rather than, like a year ago or a couple of months ago?
That's a great question. I hate to get into a conversation about, whether the takedown was engineered or not, or whether there's manipulation in the precious metals market, because what I've found is that 90% of the people, at least, really have never studied the facts or looked at all the information available that's out there.
I agree. We were just discussing that before we started recording, especially all these experts on Seeking Alpha who write gold articles every day.
Yeah, it's really it's amazing how stubborn people are about there's, you can go and Google Alan Greenspan's testimony to Congress. I forget what year, but it was in the 90s. And he said under oath in front of Congress that the Federal Reserve stands ready to lease gold in as much quantity as needed to keep a lid on the price of gold. So if you don't want to believe it from his mouth, then you're not going to believe it at all.
And and to add to your point, Dave, Paul Volcker also said after gold and silver's humongous run from the 70s up until 1980, before they got interest rates under control and they used the Hunt brothers as scapegoats, Paul Volcker also said, well, we should have manipulated gold and silver to make sure they didn't run up higher. So he's on the record.
Exactly right. That's exactly right. What he actually said was that the mistake we made was not keeping a lid on the price of gold. In terms of kind of what happened over the last couple of weeks, and I'm not using a scientific measurement. I could actually go and calculate it by hand, but roughly, if you go and look at 24-hour trading charts of gold and silver futures over the last 2 weeks, roughly 80% of the price decline has occurred either right before the COMEX opens and or during COMEX trading, and then after COMEX trading, and then especially in the very illiquid periods of Friday afternoon after the stock market closes. There's still about a 45-minute window when the electronic global trading system still operates. It's probably the most illiquid period of any part of the trading week, and when they want to try and push the price down, that's when they really push it down. And you can go and look. The tail is on the tape, and you just have to look at the tape. If you look in that same period from about 10 p.m. Eastern Time until about 6 a.m. East Coast time, you'll see that gold and silver have either been rising or have been fairly flat in price. Now, the difference between those two trading periods is that the COMEX is a pure paper market. It's a futures market. Physical bullion does not trade on the COMEX floor. Futures trade on the COMEX floor. The contracts call for physical gold or silver to be delivered, but usually in any given delivery month, less than 1% of gold or silver is actually delivered. So it's a pure paper market, and that's why it's referred to as a paper market. If you contrast that, theoretically, the LBMA in London is considered the nexus of the physical trading market because that's where every day physical bullion is exchanged. And actually now, a big part of the physical trading market is, and a growing part of it, is in Hong Kong and Shanghai and Dubai. And so what happens is we find that most of the Eastern Hemisphere countries are the ones who are accumulating this massive amount of physical gold that changes hands every day, and they require it to be physically delivered for the most part. A lot of investors who and smaller countries with smaller central banks who are buying physical gold, they might safekeep it at a bullion bank vault in London, but that whole issue is for another discussion. So, at any rate, what it sounds like based on everything I've read, and this is coming from credible sources, and you can go to the internet and read the same things I'm reading, is that it sounded like there was, because we've heard for quite some time that there's been a growing physical shortage of gold and silver, especially in gold, over in London and over in the Eastern Hemisphere where all the buying is concentrated. And it sounded like the LBMA was possibly on the verge of defaulting on some delivery demands. And so if you go and you can see it on the tape, when the COMEX opens, boom, hundreds of contracts hit the market. It's not the type of behavior that a seller who's trying to unload a big position would, that they wouldn't sell paper like that. They just wouldn't dump it all at once. They'd work out of the position slowly over time.
Exactly, Dave, because when they try, isn't the goal to sell high, right? They would try to sell it into strength, then they would want the prices higher to unload their position, right?
Well, if you're known that you've got a big position to sell, you might not be able to sell it into a rising price or even a flat price, but you wouldn't dump it all at once on the market, because that when you dump a couple hundred contracts all at once on the market, you're doing it with the intention of pushing the price lower, because there's not enough buyers all at once who are going to take that kind of size, and when they see you coming, they're going to disappear. They're going to go away and wait and see where the price settles in, if they are buyers and they want to take advantage of your selling.
Exactly, and especially when the longs, Dave, on the futures market, most of them never even take delivery anyway. They're all leveraged longs. They're all trend traders. So if they see a big order on the downside to sell, they're going to reverse, right? They're going to close out their long and they're going to join in the shorting, right?
That's exactly right. That's part of the reason why you've got an open interest in gold and silver contracts on the COMEX that exceed by a large amount the amount of physical gold and silver that's available to be delivered under the terms of those contracts. Because hedge funds, long or short in position, they don't deliver and they don't take delivery. They're just there to try and as you say, Jason, trade the momentum and sort of flow trade what's going on there.
And so you have your own fund, and in your fund you invest and buy gold and silver bullion. So since the big drop that we had in gold and silver, what has been your experience dealing with these bullion dealers in trying to buy silver and gold? Have there been any delays, and are they charging big premiums? What has been your experience?
Well, the way our fund works is that when an investor comes in, we'll usually, our base case allocation model is 50% gold and silver bullion and 50% mining stocks. And for the last couple of years, we've been weighted more around 65-35 because we kind of felt at the beginning of 2011 that the bullion would outperform the miners. And, we got lucky, and the bullion has. But the only time that we need to buy bullion is when a new investor comes into the fund and that's when we would go into the market, and we'd either take delivery of bars from the COMEX, or a large part of our bullion holdings are 1 ounce 1 ounce minted bullion coins, either from the U.S. Mint or the Canadian Mint, and sometimes we go and we'll buy Austrian Philharmonics. Depends on what's available and what the premiums are. So as you can imagine, we haven't had any new investors come in this month. We actually have a couple coming in at the end of the month. We didn't have any come in at the end of March that I'm aware of. If it was just people adding, in a small way to their position. So we didn't go and buy bullion. However, if we were to have a big investor come in right now, we wouldn't really, we'd be able to buy 1 ounce gold eagles from dealers at somewhat reasonable premiums, but in order to keep our gold and silver allocation balanced, if we wanted to buy silver eagles, it would be extremely difficult. I talked to, we primarily source from Tolving, and I talk to them all the time, and I take a look every day at what's going on at some of the other big dealers, and right now the premiums for dealers that do have silver eagles range anywhere from $6 to $8 an ounce over spot. And I know
some of them are
APMEX,
some of them have 6 to 8 week deliveries though, even with that premium, right?
That's correct. I was just going to say that. I know APMEX is indicating they may have some stuff in inventory right now where they can deliver it right away, but I don't think it's in any kind of large quantities. But as you say, yeah, they indicate that it's a few weeks out. It's sort of indicated a few weeks out. They don't have anything definitive. Now, Tolving won't take orders unless they know they're getting an allocation in and roughly when it's coming in. So when you go to their website and it says out of stock, it means they don't even know when they're going to be able to order from their supplier. So in the most likely scenario, if we had a big investor come in right now, we would probably just go and stand for delivery on April and May contracts for gold and silver. Now, the problem that we have with that, and I don't think it's an immediate problem, is at some point the COMEX isn't going to be able to deliver. Because if enough people stand for delivery on the COMEX, they're going to default on that. Now, the COMEX contracts have a force majeure clause in them that say that they can settle in cash if they have to. So they're not 100% required to deliver physical gold and silver. And it's something that we've worried about, but it's like I say, I don't think it's an issue that's immediate. But you never know, because when it is an issue, you're gonna be settled in cash, and you're gonna be wanting to have bullion, and the price of bullion and gold and silver are gonna go parabolic at that point.
Yeah, because remember recently on the LBMA, right? It was the AM Ambrose, right? The European bank, I forget which country it's in, and they supposedly had physical gold, right, in a allocated account. It was allocated, I believe, and they were paying a storage fee, and then they wanted their metal out of the bank vaults, and it wasn't there. They were forced to be cash settled. So that's just
correct. It was ABN AMRO. It's a very large Dutch bank, and they have allocated gold bullion investment accounts for their investors. And out of the blue, they sent around a letter that said they're no longer going to be delivering bullion to settle the account. They're going to settle in cash when you cash out.
Yeah, and that sounds like MF Global type behavior right there.
It is very similar to MF Global behavior, because there were customers of MF Global who had silver sitting in COMEX vaults that they had taken delivery of and had paid for up front. And they wanted the silver, and they couldn't get it out. They had to take settlement in cash, and it wasn't full settlement in cash, because I don't think the payouts were even close to 100% for MF Global clients.
Okay, so Dave, now you've talked about some of the stress in the physical market. What do your contacts say then on the global demand for physical gold and physical silver? Is the buying really that enormous? Are there really 2 or 3 hour lines? Because we're reading the stories. You see some of them in Reuters saying that in Asia, out of Hong Kong or Beijing or Shanghai, that they haven't seen this much physical buying on the price drop in the last 10 days. They haven't seen this much physical buying in over 20 years. Is that what you're hearing too?
Well, as a matter of fact, we subscribe to it's a very expensive global bullion report. A guy named John Brimlow publishes it, and he issues about 3 a day, and he covers exclusively. Well, he covers the COMEX a little bit, but he mainly focuses on the areas where there's physical markets. So India, Hong Kong, Shanghai, Vietnam, believe it or not. Vietnam is the 5th largest importer of gold in the world. And then whenever he gets data out of Turkey or the Middle East, he reports on that also. And based on, if you look at the premiums, the import premiums in India, the way India works is when you want to buy gold over there, you have to pay an ex-duty import fee, and there's a premium in it that's over the ex-duty import fee, and if the premium's positive, it generally indicates there's a lot of buying going on over there. Occasionally it goes negative, and it kind of depends on daily movements of the price of gold and daily movements of the rupee. Well, yesterday when you reported the premiums from Monday night over there, the AM premium was $75 an ounce over the spot price of global gold, and I've never seen the premium that high. Generally, I've been reading this report for a long time, and generally the premiums go from 0 to maybe $10. $10 is usually high. It was $74 on Monday night. That was the AM premium. The PM premium was $49. And then today, I can find the report. Last night, the premium there was, call it roughly $50 and $35 AM and PM. And what that means is that essentially people are lining up around the block to buy physical gold over there. I mean, the demand has just gone parabolic over in India, and we're he's reporting the same type of occurrences over in Shanghai. So I mean, you and I we both read kind of the same Reuters reports, etc., and demand has just gone through the roof in these physical buying countries. I mean, they're looking at this as a gift from their God that prices are this low now.
And so the high premium tells you that there's a high demand for the metals, and right now the supply is very tight as well. So we want to shift gears here and talk about the mining industry and how they've been affected by this big drop. Usually the explorers...
Can I just cut in here real quickly here, because I just found the report from this morning that the Indian ex-duty premiums last night were $48.84 AM and $66.95 PM. So
that's the highest I've ever.
His comment is crazily high and indicating India is starved for gold. And then there's a UBS has a metals group over in London, and it's probably the best Wall Street type research group on Wall Street. And their comment from their report today was, our physical flows to India are close to the highest levels we've seen since 2008, indicating very robust appetite from the region.
And on top of that, it's the buying season for gold in India because of the New Year. And
wedding season, yeah.
Yep, so the big drop is pretty much, I'm sure they're very happy about that.
Exactly,
so,
they definitely are.
Yeah, definitely. So, anyway, going back to talking about the mining industry and how they've been affected by the big drop, the explorers and the junior miners, they're being impacted a lot by the big drop. But some of the senior producers, even like Barrick Gold, is being impacted by this big drop. I just found out yesterday that they're having a fire show and they're selling some of their mines in Australia. So
and
they've been
about to get credit downgrades too, from what it sounds like. A whole bunch of credit analysts said if the gold price drops even a little bit lower, they're about to get massive credit downgrades too.
Yep.
Wow.
So I wanted to ask you, so if the prices stay this low for a while, how do you think the mining companies will react? Do you think some of them will go bankrupt, or will they have to shut down their mine until prices recover, or do you think they will withhold from the gold and silver until the prices go back up? What do you think?
I think it kind of depends on each individual company, because as you know, each company has its own unique cost structure. We in general don't like to invest in the big multinational mining companies like Barrick or Newmont. I personally don't think. Yeah, most of the big ones are very poorly run. They're run like government bureaucracies. The philosophy is get the gold out of the ground and sell it. Don't worry about the price. Let's just move volume. Let's keep our fixed costs as low as possible. But the other thing that a lot of these big companies have is they've got environmental problems in a lot of these countries. Newmont always has an environmental lawsuit in other countries going against it, and then they've got political problems, which we've seen with Barrick's silver mine down in Chile. So
and there's cost overruns. Yeah, there's cost overruns too, Dave. Yeah, they never hit their earnings. Yeah, the Pascua-Lama project for Barrick is like the best example. That thing was supposed to be under $2 billion in capex, and here we are 4 or 5 years later. It's over $8 billion, and it's counting, and it's looking like there's more environmental lawsuits. So that's going to be an albatross.
That's exactly right. So we try to stay away from those companies. Instead, like you guys, we want to focus on. We actually, I like some of the intermediate kind of mid-tier producers like New Gold, and then we like to focus on the companies that are developing deposits that companies like Barrick and Newmont will eventually come back and overpay for because they need to bolster their reserves. So I think a lot of these type producers, and I know some of the silver miners like Endeavor, if the price gets hit too much, they just mine their silver and they don't sell it. They wait until the price goes up. A lot of entrepreneurial silver companies end up doing that. I don't think Barrick and Newmont ever stockpile their bullion, and wait
Barrick
for a
and
higher
Newmont,
price. They just
Barrick and Newmont run too much of a leveraged balance sheet to do that because they have too much debt. They can't afford to hold it back. A smart company.
That's right. I think that's right.
Yeah, a more prudent company
believe it or not, Barrick actually, even though they made a big announcement about removing all their hedges back in 2009 at the Denver gold show, I remember that specifically when they made that big announcement. But if you go through the footnotes of their financials, that statement's only partially true. They continue to have what they call property-specific hedges on ones that they're developing, and I think Pascua-Lama, or however you pronounce it, is one of those properties, and that may be one of the sources of their problems down there.
They also owe big. Well, yeah, Barrick also owes big royalty and streaming deals to Silver Wheaton and Royal Gold. So, yeah, Barrick's in the hole.
Yeah, and so, but some of these, the more intermediate, New Gold's a good example. I mean, they've got a relatively low cost structure. They're nimble. They're smart operators. Pierre Lassonde is on the board. He's about as sharp as they come, and I think they can withstand even a lower gold price, and it's not gonna. I mean, it'll hurt their cash flow, but it's not going to cripple the company. And then you go to the juniors, and we try to only invest in juniors that have at least a year or two of cash on their balance sheet, based on, say, their trailing run rate of cash burn. And again, what happens is a lot of these juniors just cut back on their spending. They cut back on drilling and development until the financing market gets better. So if you think that gold and silver, if you think the bull market's not over, and I think it's a long way from being over, as long as you're sitting with juniors, even though they've gotten the crap beat out of them price-wise, if you're sitting with juniors that have, a fair amount of cash on their balance sheet, they're not going to go out of business. There's going to be a lot that do, though.
Yeah, there's been a lot of inefficient operators, Dave, who, when silver was at 48, 49, they could have raised capital. They could have maybe sold some shares then, and yes, dilution is bad, but, it's better than the company going bankrupt or management team selling out the assets for pennies on the dollar, and they didn't do it then. And now here they are, and they need capital, and they didn't raise it back then when they should have. So it just shows you, I guess, like you said, it's about case-by-case basis. But what's your opinion, Dave, on the all-in production costs for the gold miners? Because it seems the production costs industry-wide, some companies have obviously been able to mitigate this, like New Gold, First Majestic Silver, Keith Neumeyer, another quality one, have been able to mitigate this better than others. But industry-wide, though, the whole industry has just seemed to have been dealing with 10% per year cost increases really since the QE1 program started. And all these QE programs globally have just been, compounding all this inflation in the value chain, in the global supply chain. And it seems to really be hurting the miners more than any other sector.
Well, again, I think you kind of have to differentiate between what the cash costs are and what the all-in costs. And you see a lot of these analyses, they're when a mining company develops a mine, they incur all these upfront expenses. It's very expensive. And then they amortize that very slowly over time. So when you're talking about the all-in cost of mining, a large portion of that cost is going to include non-cash, GAAP charge for amortizing what's already been spent. So I still think, I know they changed the reporting standards in terms of, historically these mining companies were just reporting their cash costs. And I know that's changed, but and now they're reporting all-in costs, and they should be reporting that because it's actually a good measure over the long run of what your cash-on-cash rate of return is. But in terms of if as long as a company can pull gold or silver out of the ground and do it and sell it for a higher price than what their cash costs are, they can they can keep running on the wheel until the price of gold and silver goes a lot higher. So, and ultimately the reason why we're in this game is that we believe gold and silver are going to much higher price levels, and
either that or there's not going to be any supply available. The miners
exactly.
Yeah.
That's right.
There'll be a total dislocation then between the paper market and the physical market. The physical price will be humongously higher. The miners will all be bankrupt. I don't think that's going to happen completely. I think some miners will go bankrupt if the price is correct for a little while longer, but I don't think all of them are going bankrupt.
That's right. We're not going to see that scenario. The market will correct all of this at some point. But if gold was at $2,500 an ounce right now, and it would probably be a lot higher if the market wasn't manipulated, we wouldn't even be discussing cost structure for these mining companies because it wouldn't be an issue.
Very true.
Yeah, if you look at the companies like Barrick Gold, their all-in quote-unquote cash cost is $940, but if you look at their free cash flow, they're in the negative. So there's something wrong with how they calculate their cash costs there.
That's exactly right. And again, I probably point to a lot of the sort of litigation costs they face, and there's also, again, I haven't looked at Barrick's financials in a couple of years because I just don't care about Barrick, but I know they've got those embedded hedges, and when they supposedly took those off, gold was at about, I think it was around 800 an ounce at that point in time. But again, it was deceptive because where they had property development, property specific hedges, they didn't classify those any longer as hedges, but that's basically what they were, and they're still liable for payments as the price of gold goes higher. So they still have some cash burn from that. And I'm sure I could, pull it out of their financials if I really wanted to take the time just to study their latest 10K. But
I think we just want to, Dave, I think we just want to point out to our listeners that the miners have been underreporting their all-in production costs for a while. Legally, I guess, because the accounting rules permit it. And, it's kind of immoral, though, because, the shareholders think that this company, gold's at $1,600, Barrick's cash costs are $900, they should have $700 an ounce in free cash flow, right? And they're not producing anywhere near those numbers. The governments, the foreign governments, where these mining companies who have foreign deposits are operating see these reported cash costs, right? And they think, oh my God, the profits are enormous, right? And they keep raising the royalties and the taxes every year. And then this is why you have a problem like this with the mining companies, where when gold, basically when gold was above $1,600 and silver was around $20 to $30, most of the producers weren't making any money.
That's right. That's exactly right. And you bring up a good point about, for them to understate their costs by just reporting cash costs definitely exposes them to the political risk in some of these foreign countries of much higher excise taxes. There's no question about that.
So one final question I have for you is, I know you analyze a lot of the mining companies out there, and with the big drop that we just had, a lot of them are, now producing negative cash flow. For example, Silver Standard, their all-in cash cost at $27. Now with silver just below $23, they're not making any money on some of their mines. So, in your analysis, have you able to determine a floor price for gold and silver in order for the miners to stay profitable? Because I've seen numbers like $1,300 and $1,200 for the gold miners.
That's a good question. I actually don't. I don't get that detailed in terms of analyzing everything, because again, we don't invest in these larger multinational companies.
And the only reason, Dave, as you pointed out, with this whole thing, is that the paper prices have been smashed so much, and the miners, their input costs have risen, their margins have just gotten out, most of the companies, their margins have just gotten absolutely destroyed, and now we see, all these technical analysts saying that gold could go below 1,200, gold could go to 1,000, gold could go below 1,000. That would bankrupt more than 50% of the industry, gold below 1,000. I've looked at hundreds of projects, Dave, in the last few years, hundreds of PowerPoint presentations, project economics, etc., and almost every single gold mine that has been brought online really since 2010-ish has had a base case of $1,200 an ounce gold for break-even, for profitability. And that was before, all these QE programs. So it's just really remarkable here. And what else is remarkable, too, is all of this global QE, it's caused massive distortions, massive asset price inflation, and we just haven't seen it in the commodities markets.
That's right, but we will at some point. There's no question about that in my mind. We will see that at some point. And when it is silver again, that's when we're off to the races with a real, the gold rush will resume.
Yeah, it's just mind-boggling. Maybe it's because the dollar. Maybe it's just because a lot of the money's hot money, and because people are flight capital out of Europe or Japan, and a lot of the money's coming here into the U.S. stock market, in U.S. real estate, and in U.S. dividend stocks, large cap dividend stocks, and stuff like that. But there's just so much inflation in asset prices that eventually you'd think rationally the money is going to go into the commodities market, and it just hasn't for over 2 years.
Yeah, but you know what? It's commodities always, they kind of go in trends, and now we're seeing the commodities kind of overshoot to the downside. And, just like we saw silver overshoot to the upside on an intermediate basis back in 2011, And again, that a lot of that was driven by the paper market on the COMEX, because the shorts were scrambling to cover their short positions as the price ran up and started to get away from them. So now we're seeing the reverse to the downside, and I think the last 2 weeks has probably flushed out most of everything except the very strong hands and most, if not all, of the speculative money that came into the sector after 2008.
Yeah, I agree. I'm starting to hear that that chatter that I'll never buy gold again. It was the same chatter, guys, that was right after the 2008 stock market crash. I'll never buy stocks again, and now people are buying stocks.
That's what's so extraordinary about this price hit. I mean, up until this time around, whenever there was a big price hit in gold and silver, the people who were buying minted coins and things like that scattered. And this time, with the price hit, they're doing just the opposite. They're going and they're buying up everything they can find that's available out in the market in this country. I mean, I was actually kind of surprised by the reaction that the public's had by this price hit. And, we've seen, going all the way back to 2001, there have been periods where gold has dropped 20%. And what happens is, everyone goes away and they disappear. They stop buying. They weren't buying the dips back then.
That was before quantitative easing, though. That was before all these global QE programs. Maybe other countries were printing money, but it wasn't on the scale that it is now, right? So.
Right, and also the precious metals market itself and the attention it was getting wasn't like it is now. But back then, all the way from say 2001 when I started in on this sector to 2008, whenever you had a big price hit in the metal, buyers just scattered. And this time it's been just the opposite. You had this big price hit in the metal, and buyers, like I said, they're scooping up everything they can find.
I think that's, Dave, because people realize that kind of the stock market, a lot of the reason the stock market is rising is mostly like printed money and liquidity, and same thing with the real estate market. There's not really the fundamentals there for the most part to justify a large rise in all these different asset classes, especially all at once. These asset classes are not supposed to all rise at once. So I think people are starting to figure it out. Maybe it's because of all the information on the internet and all the printed money and stuff like that people are hearing. Because when you start seeing all these real estate, the real estate bubbles basically reinflated, all cash deals, people coming in from China, Middle East, Europe, South America, here to the United States, and buying real estate up as soon as it goes on the market, bidding wars again for all cash deals. We're back to a bubble.
Oh, we're there. I mean, and the all cash deals that you're talking about, the bulk of that are New York and Los Angeles-based investment funds that are building up huge portfolios of distressed properties that they plan on turning into rentals. And there's a lot of I also, a hobby of mine is to cover the housing market because it got so absurdly overvalued in the early 2000s up to the crash in 2007. That it's one of these things that irritates me, so I like to try and expose what the facts are with that. But
we'll save that for another podcast. Then.
Right, but essentially, what you're seeing is the organic home buying market is really it's not there. It's being somewhat supported by the $40 billion a month the Fed is throwing into the mortgage market, but with personal income, especially on an inflation-adjusted basis, starting to decline and less people having jobs, when you look at the labor force participation rate, the fundamentals just aren't there to support another housing boom in this country. So what you've seen is these big investment funds have cleared off a lot of the distressed inventory, and they're going to try and turn them into rentals, and it's just not going to end well. So, but, back to the stock market, I mean, the stock market itself is completely dislocated from the fundamentals that underlie the stock market, and we're probably, at least the S&P is more overvalued now on a relative basis than it was in 2000.
Wow.
Well, Dave, we appreciate having you on for a podcast. If people want to find more about your fund, where can they go?
We have a website, goldenreturnscapital.com, and if you go to that website, you can. There's a mechanism on there that if you input your email address, it'll go to my partner, Dean, who's in charge of marketing, and he can set you up with a temporary password to see what we're all about. And
you're also on Seeking Alpha, is that correct?
Yeah, I've been publishing some stuff on Seeking Alpha under my name, Dave Kranzler. If you just search under that, or you might be able to, it might come up if you search under Golden Returns Capital.
Okay, great.
I've been, publishing mainly on the gold and silver bullion market. I've done one mining stock report. I'll probably do a lot more when the market recovers. And I cover the economy and housing also.
Okay, great. Well, we appreciate taking time to come on a podcast with us. Please come on. Hopefully, we can come on again. Thank you.
Yeah, I appreciate you guys having me. Jason, it was good to catch up with you, and Mo, it was nice to meet you, and we'll speak soon for sure.